Can Bob Iger turn the story around at Disney, or will the stock continue to see its price slide over the subsequent quarters? Hey guys, hope you're doing well out there. Today we are taking a look at Walt Disney Company, ticker symbol DIS. We'll dive into some segment revenue and operating incomes. We'll take a look at it from the all-important paid subscriber growth at Disney Plus, and spoiler alert, it comes to a screeching halt. Jump into the statement of income, balance sheet, and the all-important cash flows, and as always, dive into the technical analysis for Disney. This one's at a key level of support and can make for a good swing trade opportunity, or perhaps even a short selling opportunity. As always, if you are new to the channel and find this type of content valuable, be sure to hit that like and subscribe button. It would mean a lot. We are on the road to hit 1,000 subscribers. Disney in the after hours shares are popping up 2.5%. This one has a market cap of roughly $161 billion, an absolute juggernaut of a company. They posted their third quarter 2023 results, EPS coming in at $1.03 per share adjusted, beating analyst expectations of 95 cents per share. So a nice beat on that bottom line. Revenue coming in at $22.33 billion. That missed consensus estimates of roughly $22.5 billion, miss on that top line. Now, the all-important Disney Plus total subscriptions, this is what the street had their eyes on. That came in at 146.1 million versus expectations of 151.1 million. And so initially the stock did see declines of roughly 3% in the after hours. That was likely due to this total subscription number missing. However, after Bob Iger got on the conference call, stock is seeing some nice recovery. Disney did record a $2.65 billion one-time impairment related to pulling content off of its streaming platforms and ending third-party licensing agreements. We'll see that in their statement of income. Disney says it will crack down on password sharing following Netflix's lead. So Bob Iger got on the conference call Wednesday evening and said Disney will be following in Netflix's footsteps and crack down on password sharing. We know password sharing has been relatively successful for Netflix in minimizing churn and seeing those new subscriptions come onto their platform. Certainly, Disney is trying to follow in that footsteps and see subscription additions to their Disney Plus model. Disney looking to raise its price on the ad-free model on Disney Plus up to $13.99 per month starting in October. So it looks like Disney is increasing the price of Disney Plus and Hulu without commercials, but is leaving the price stable for its product with ads. We can see Disney streaming services lost $512 million in this quarter, and they're also launching a new premium duo product for Disney Plus and Hulu without commercials for $20 per month. Certainly, when we look at Disney's average revenue per user and subscriber growth, we know that has been halted, and so we'll see if Disney has the room to squeeze more revenue out of their existing subscribers without seeing too many losses in that subscriber count. ESPN launches a sportsbook in partnership with Penn Entertainment. So ESPN, which is wholly owned by Disney, is looking to relaunch its sportbook as ESPN Bet, and they're doing so by partnering with Penn Entertainment. They will launch this fall in the 16 legalized betting states. So ESPN looking to get into sports betting. This is looking to give ESPN another revenue stream as their traditional TV business is weighing on their revenues. And Disney is also likely to shore up on cash as it's losing money on the streaming unit. It's also looking to acquire Comcast's stake in Hulu next year. So Hulu, which is owned 66% by Disney and the remaining 33% by Comcast, looks like Disney is looking to acquire that remaining stake in Hulu from Comcast. That will be a roughly $9 billion acquisition for Disney based on a $27 billion market cap given to Hulu. Certainly seeing Disney diversify its revenue stream and look to get into sports betting, we know DraftKings is the biggest player in that space right now. Certainly this could be a good revenue stream for Disney if they are to capitalize on it well. Taking a look at the segment revenues and operating incomes at Disney, we see this paints two completely different stories. We have Disney Media and Entertainment Distribution. That includes their linear networks such as ABC, Nat Geo, and the Disney Channel, as well as direct-to-consumer, which includes obviously Disney Plus, Hulu, and ESPN Plus. that posted revenues of $14 billion in this most recent quarter. That was flat to down on a year-over-year basis, down 1% from roughly $14.1 billion a year ago. On an operating basis, that segment generated $1.1 billion worth of operating income from $14 billion of revenue. That was down on a year-over-year basis, roughly 18%. And so certainly when Disney says they need to increase their subscriber count and increase that average revenue per user, they have to turn around this operating income, and that's one way to do it. Now, not all is bad at Disney. Taking a look at Disney parks and experience products, this includes your theme parks and cruise lines over at Disney. That posted revenues of roughly $8.3 billion in this most recent quarter, up from $7.3 billion same time last period. That was good for 13% growth on a year-over-year basis. Now, seasonally, this is supposed to be a strong quarter for Disney parks and experiences. It's the summertime, kids are off school, and temperatures are good out here in North America. Certainly in the winter seasons, Disney parks and experiences does not perform as strongly. And so seeing this 13% growth on that park side is certainly saving Disney's top line. Overall revenues coming in at $22.3 billion. That was good for just 4% growth year over year. And even from an operating basis, the Disney parks experiences is what's keeping Disney afloat, and has been for some time, as the digital media segment has continued to see declines. On this park side, Disney posting operating incomes of $2.4 billion. That was good for 11% growth on a year-over-year basis. Breaking down Disney's media and entertainment distribution, so we see they have this linear network segment, which consists of ABC and Disney Channel. That was down roughly 7% on a year-over-year basis. The D2C business, which includes their streaming services, did see 9% growth on a year-over-year basis, but we'll see this is a money loser, as from $5.5 billion of revenue, they actually lost $500 million on an operating basis. Now, this loss is substantially lower than a year ago, where they lost $1 billion, and so that operating loss has narrowed, but the streaming side is still seeing significant operating losses, which need to turn around if Disney is looking to turn around their overall operating profitability. Taking a look at paid subscribers over at Disney, this paints an absolutely ugly picture, as subscriber growth has stalled in every single one of their streaming services. Whether we look at Disney Plus Core, which saw just 1% growth on a sequential basis, Disney Plus Hotstar actually saw 24% declines on that subscriber count quarter over quarter. Even ESPN Plus saw flat subscriber growth, and same with Hulu, which saw no subscriber growth, up to just 48.3 million paid subscribers. So certainly when Disney says they need to follow in Netflix's footpath of cracking down on password sharing, while that might suck for consumers like me and you, certainly it is needed if Disney is looking to grow their paid subscriber count in any meaningful way. Taking a look at the average monthly revenue per paid subscriber over at Disney, we see this has come to an absolutely screeching halt as well, let alone a decline in certain areas. We see the domestic area, this is where they generate their highest average revenue per user, went up just to $7.31, up 2% on a quarter over quarter basis. Disney Plus Hotstar saw flat ARPU growth, and ESPN actually saw declining average revenue per user down to $5.45. And even Hulu, which is their most prized streaming platform, which is supposed to see very strong growth on that subscriber and revenue per user count, saw just 6% growth on that SVOD, up to $12.39. Now, it's interesting to see that Disney is saturating on this average revenue per user growth when they say they're looking to raise prices on their ad-free models. We'll see how much consumers can actually pay, and there must be a level where raising prices will cause consumers to switch over to the numerous other streaming platforms that are out there, whether that's a Netflix or an Amazon or an Apple TV. Certainly there's a price where consumers get squeezed too much and either switch over to the ad tier business or leave the platform altogether. Taking a look at Walt Disney's revenues, that came in at $22.3 billion. Cost and expenses coming in at $19.6 billion. So you take this 22.3, subtract off 19.6. They also had this one-time $2.6 billion impairment related to the content. And yes, we turned to an operating loss of $134 million. I can't remember the last time Disney posted an operating loss. Might be in the COVID pandemic. Moving down to the net income, we see net income attributable to Walt Disney coming in at a loss of $460 million. Same time last year, we were sitting at a net income of $1.4 billion. The statement of income absolutely not painting a pretty picture and really just confirming everything we've been hearing from Disney, whether it comes to declining subscriber growth, declining average revenue per user. That certainly shows up in their statement of income. Moving on to the balance sheet, it doesn't get any prettier for Disney. Certainly this balance sheet is one of the worst that I've seen. Cash and cash equivalents sitting at $11.4 billion, receivables at roughly $13 billion. And so overall, their current assets at roughly $30 billion with around $25 billion of very liquid assets. Now, I do want to highlight that the majority of Disney's assets come in the form of parks, resorts, and property. Certainly all those Disney theme parks and hotels and cruise lines are not cheap, and they are recognized right here on Disney's balance sheet. Now, their total assets coming in at $203 billion, total current liabilities coming in at roughly $30 billion. And so you take a look at your $30 billion current assets compared to your $30 billion current liabilities. Certainly not a current ratio that we would like to see. We also have a ton of long-term debt on this company, roughly $45 billion of long-term debt. And so their net debt is sitting roughly at $30 billion as well. If you take this $44 billion, subtract off the cash and cash equivalents, you get that net debt of close to $30 billion. And certainly I do want to highlight that this long-term debt is affecting them quite significantly, as they're paying quite a bit of interest on this. We can come up to their statement of income and see that their interest expense in this most recent quarter was roughly $305 million. That is significant considering they posted an operating loss of $134 million. Certainly if they were to reduce the debt on the balance sheet, they would have to pay less interest expense, and that would ultimately help their operating income. $305 million for a company that's posting $3.7 billion of operating income is not a small amount. And so Disney should certainly look to reduce the long-term debt on their balance sheet. Moving on to the statement of cash flows, and I'm sorry to say it does not get any better for Disney. We bring down that 9-month operating cash flow of $2.7 billion. That was down from roughly $3.3 billion a year ago. We get to add back things such as depreciation, amortization, and large amounts of it for Disney, roughly close to $4 billion of depreciation. We come down to an operating cash flow for 9 months of $5 billion. Now, certainly let's see where Disney deploys this $5 billion of free cash flow. Well, they spend roughly $3.5 to $4 billion of that in investments into their park, resorts, and property. Certainly that is a highly capital intensive business, and they have to keep upgrading the amenities and attractions at those parks to continue to see people come into their parks. They also paid down roughly $1.3 billion worth of that long-term debt, and so they spent around $3.2 billion in investing and another $2.1 billion in financing. All and more of their free cash flow on a 9-month basis was wiped out by their investing and financing activities, and that burned through another $150 million worth of cash on their balance sheet. So certainly Disney is in no position to do stock buybacks or even pay a dividend. They're using everything and more of their 9-month free cash flow just towards their theme parks and paying down their long-term debt, which they should be doing at an even faster pace, in my opinion, considering how much interest expense they are paying. Moving on to the technical chart over at Disney, this one is in a steep downtrend and is seeing levels it's basically seen back in 2014. That is just incredible to see. Now, where this green line is, that is a level of high support. It's acted as support numerous times over the past decade, and this is actually surprisingly where the COVID lows actually also happened. So considering all the Disney theme parks and cruises were absolutely shut down, this is when Disney pivoted to their streaming model and had very low prices to grow their subscriber count, which saw nice share returns. But now, as investors are looking towards profitability, they must deliver on that, especially on that streaming business. So you can move this green line around to roughly $85 to $90 in this area is where I see a strong level of support. Now, it does seem that Disney likes to consolidate in this sort of range, and perhaps it could see a nice recovery up to 110. And so if you are interested in picking up shares of Disney at this level, I would set a stop loss very close by, close to $80, and hope to ride out shares of Disney up to the top end of this range, close to $100 to $110. I would set the stop loss because if Disney shares give out of this $85 level support, well, there's not much holding this one back, as there's not a whole lot of support down here, and shares could come down to as low as $50 really in a hurry. Now, if you do feel a bit more ballsy and on that risk-taking side, certainly you could play this from a short selling perspective, because this level is such a key level that if it breaks it, it could come down in a hurry. Certainly, in my opinion, I'm not playing Disney on either side. I'm sort of watching this one from the sidelines to see what it does. I just think it's too much risk in this stock, as their balance sheet, their income statement, their operating incomes, it's all very ugly, and I feel like I could get better opportunities in the market at the current time. Certainly could be interested in Disney down the road if the business turns around, or if the stock absolutely falls off a cliff and the valuation comes south of $100 billion. That was Walt Disney for you guys. Let me know what you think of this one in the comments below. I'm staying away from Disney at the current levels, but let me know if you are buying, selling, or holding Disney shares. As always, thanks so much for listening, and I'll see you guys in the next video.